The following video was recorded at Nexus, the private investor summit hosted by PEI Group in March 2025.
So we're here today with Milwood Hobbs Jr. He's the co-head of direct lending and sourcing and origination at Oaktree Capital. I'm Robin Blumenthal. I'm the America's editor of Private Debt Investor. So we're going to talk a little bit about what's been going on in the market this week.
Thank you for having me, Robin.
Thank you for being here, Milwood. It's great to see you.
It's great.
So we had a great, I'm not great, but we had an interesting start to the week with the markets really being disrupted,
Right.
which is what, private debt really likes. So
Right.
give us a sense of how you're looking at this.
Well, I think we've had most bull markets last 8 or 9 years. We're almost 16 years into this bull market, and I think what drives market movement is psychology, right? Which creates what we see now, anxiety and volatility. And so the market movement, while it seemed extreme at one level, I think it's pretty interesting that we've been in a period since late 22 of higher interest rates. Mm-hmm. And I think what we have to take into appreciation is that markets are very liquid. There's a lot of liquidity. There's a lot of liquidity in private credit. As interest rates have risen, that has created some stress on the underlying cash flows of businesses. And at the end of the day, the drivers of the economy are you manufacture products and you consume those products. Mm-hmm. And if 70% of GDP is driven off consumption, right, the consumer, if you just go back and rewind COVID, consumers saved about $2.5 trillion. That's all gone. If you look at credit card balances, they're higher than they were pre-COVID. And so at some level, the consumer is a little winded, a little
Tapped
tired.
out.
Yeah.
Yes.
And when you have that phenomenon, that causes you to pause and think about discretionary transactions and, food. We're talking about eggs, right? Eggs are pretty expensive. And so the shift of your cash flow from consumption or buying of products to just maintaining a lifestyle certainly should find its way impacting the markets. Now, on top of that, we have tariffs and potential situations that could cause stress globally. And I think the markets are digesting and processing that information. And part of that process of information is movement in the stock price.
Absolutely. But in terms of, fixed income markets, there's been a little bit of a rally.
A little bit of a rally.
So all of that said, and the sense of the fact that the consumers a little tapped out, businesses, are going, they're facing much higher leverage.
Right.
They're having, to eventually pay for their PIC,
Right.
amendments that they, kick the can down the road.
Right.
So, how will that affect your decision making and, overall private debt? Are we going to see just a bunch of, defaults, refinancings? What do you think is we're going to look at?
So I think fortunately private credit has emerged as a pretty large asset class, right? If you think about the size of the market, it's about 1.8, 1.9 trillion today. And the expectation is by 2028, 2029, depending on who you believe, it could be a $3 trillion market. And what's driving that is a couple things. Number one is there's a significant amount of dry powder sitting within private equity firms. Mm-hmm. The one good thing about volatility, and you've talked about this and written about it, is that valuations probably come down a little bit. And that would ignite M&A transactions from private equity. So,
right.
So the $4 trillion that sponsors, private equity firms have to deploy really is an opportunity for us to put more capital to work, number one. Number two, if you look at refinancings, a lot of what was coming due in 26 and 27 has been refinanced. Mm-hmm. So if you think about maturities on the high yield side, 85% mature 3 to 5 years. Mm-hmm. So there's a little bit of time on the refinancing. So we do need M&A to pick up.
So sort of counterintuitively, the route in the market could
Could be a good
basically,
thing. Could be a
could
good thing.
stimulate M&A,
Right.
which everybody's been waiting for years now.
It would, not only does it stimulate M&A, but it brings a little bit more what I call rational behavior in the markets. And so what we're finding in today's markets is capital is really the commodity. And given the amount of capital that has to be deployed by all of us, at some level you have to debate, are you truly pricing the risk? And with volatility increasing in the markets, there's a little bit more of a focus on, am I pricing risk? Because everyone will sort of sit back and decide based on existing positions, based on revolvers, delayed draws, fundraising, how to deploy capital more judiciously in a more volatile market.
So, the big problem in the M&A market is that buyers and sellers can't come together on price. I mean, I guess you would think that, with the public markets coming down this way, maybe people get a little bit more realistic about valuations. But that will possibly create a problem for, managers who, anticipated higher exits and returns.
Well, the math would suggest that valuations, if higher interest rates reduces cash flow, free cash flow to the business, at some level that would reduce the valuation, because if you think about valuation of a company, it's just the cash flows discounted and then the terminal value, which is driven off what I would call market comparables. So if the market pricing is coming down, right, where these businesses trade comes down, thus the terminal value of those businesses comes down. So when you take lower cash flow, free cash flow, plus lower terminal values, the math would suggest a CEO has a lower valuation. Now, their ability to get comfortable with that is we've been in what I call these mini sort of shocks where they haven't had to get comfortable with that because the markets have rebounded pretty quickly. If we have a little bit more of a longer term muted sort of valuation market, then they do have to get comfortable with the math. And at some level, you can't defer strategic decisions forever. So I think that valuations coming down, volatility in the stock market reduces the cost of equity and valuations, then I think actually increases the cost of equity and reduces valuations. I think then we have a more rational M&A market.
Yeah, totally. So in terms of how this will impact the private debt markets, I mean, where will Oaktree is an opportunistic lender, and I guess you guys, you raised a $16 billion fund, so this might be good news for Oaktree.
So look, what we're trying to do, and in my seat, I originate across the firm, right? So what we have moved from is away from this strategy does this strategy does that. No one really cares about the 15 plus strategies you may have in your platform. What they do care about is, can you solve my issue? And so we've migrated to being a capital solutions provider that looks at a situation and figures out, can we solve that on behalf of our clients? And then we figure out where that should be solved.
Yeah.
So for the majority of our situations with the institution of my group, more than two strategies see any one deal within Oaktree, because our view on the world is the best solutions comes from the maximum number of minds and capital that's available to look at it. So I think for us, we're kind of like in this thing where in today's market where there's a lot more capital, I think you have to be very smart on asset selection and very smart on, are you backing the right businesses with the right partner?
Yeah.
In markets that are more volatile, I think what's interesting about those markets is that you can price risk, and what you find is a lot of folks in this market are not accustomed to pricing risk, and they tend to freeze. And so there's an opportunity to sometimes get a premium, not because of the volatility necessarily in the market, although that's one aspect of it. The other is there's just fewer folks looking at a deal. And so what we want to be set up to is not necessarily worry about, like Howard would tell you, we don't macro forecast. But what we will do is we will try to look at the markets and price the risk based on the market we're in. And I think in today's market, you just have to be really smart about the assets you select.
So capital solutions is it.
That's the
new buzzword.
That's the new word.
Yeah.
Capital solutions provider. And you've got ABF, asset-based financings, which has become big. And I think the reason that that's become a trend is if you go back, I worked at GE Capital a long time ago. They were a pretty large ABF provider. And between the regional banks and Siemens, GE Capital, some of these platforms, they were truly the providers of this ABF, asset-based financing. What's happened is, if you think about regional banks, their largest assets are commercial real estate and C&I, commercial and industrial, which is really middle market loans. And just given the movement in rates, they can't sell those assets at a loss because that can sometimes trigger a capital deficit, which could create a run. So what you're seeing the banks do is these SRTs, which you wrote about recently, these systematic or synthetic risk transfers, and then they're just, instead of selling assets at a loss, they're just lending less, which has created that growth in ABF because they are retrenching from the market. Now, ABF is not that easy to do either.
No, everybody thinks it's just.
Everybody thinks it's easy, right?
It's easy. Yeah. It's easy to explain. No, it is
easy
not.
to explain. Not really.
Not
right?
It
right.
isn't, because it spans. It runs the gamut of so many different things.
And think about it like this. Just think about it from a car rental perspective, right? The companies that rent cars are large users of asset-based financing, right? For that car to be utilized, someone has to get on a plane, fly, need a car, rent the car, and use the car. If you think that there's potential degradation in volumes of business travel or even leisure travel, that car doesn't get utilized. But guess what? The interest associated with that car, even though it's not generating revenue, still exists.
Right.
So I think when you think about the income stream of an asset, you have to think about the revenue that asset can create. And if it's too much of those assets, the revenue per transaction goes down, volumes go down, and you've got an issue.
Well, you do really have to look pretty far out into the future and, underwrite for all these different risks.
Correct.
So I
Correct.
think the people who haven't done, like somebody on a panel I was doing the other day said, I asked people, how many workout people do you have? He's like,
Haven't needed one,
yeah,
right?
right. We don't have
Right.
any.
Right.
So I think that probably the companies, the lenders that are, well-versed.
Well-suited and well-rounded, yes.
Will probably be able to, take
weather,
advantage
yes.
of this.
Right.
So,
right.
yeah.
And I think that's going to like I said, the bull market's been around for a long time. No one wants to predict failures of companies, but no one predicted interest rates would go from 0 to 5%. So I don't think anyone would say this out loud, but the majority of balance sheets and capital structures that were put in place from 1819 are still outstanding or effectively over-levered because no one predicted rates would move this much. So the providers of capital are now looking at situations that are over-levered. So that should shrink capital availability to those companies. And then folks are talking about default rates when the reality of it is a default rate doesn't really move me as much as recoveries. And as you think about over-leverage or picking, when you're starting to pick, you're really sort of reducing your ability to recover on that business or that instrument.
That's great. Well, thank you so much,
Thank you
Milwood,
for having me.
being with us.
Thanks for watching. For information about PEI Group's entire portfolio of events, please visit peievents.com.